Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hi, everybody. Welcome to the podcast today. I've got a special guest, Phil Hodgen. Welcome to the pod. Welcome to the podcast. How are you today?
Thanks, Mishkin. Doing good.
I met Phil several years back. I believe it was in Texas. They have this thing called the International Tax Symposium. And I'm pretty sure that's where I met Phil. But it was a conference, and Phil and I were both presenting. And I remember Phil went on before me, and I had to follow him up. And it's kind of like following Elvis or, a major performer, because he does such a great job. I forget what you were presenting on, Phil, but I remember thinking to myself, oh, golly, now I got to go on after Phil. He just went in there and slayed the crowd with whatever international tax topic he was talking about. But I'm a big fan of what Phil has been doing. For anyone that has the opportunity to look at his website or attend any of his presentations through CalCPA, the quality of the work that Phil does, and I think what Phil does is kind of akin to what I'm trying to do here on the podcast, which is taking these really complex international tax topics that we seem to run across and trying to distill them down and to where people can really kind of get good takeaways, try to understand them in layman's terms, have actionable items. And in some cases, one of the areas I really like is calling out some of the hypocrisy of what the rules are and kind of the things that they have going on there. But I'm super excited to bring in Phil today. There's a couple big topics that I want to talk to Phil about that I think will resonate with our audience. I want to talk to Phil about issues related to the Foreign Investment and Real Property Tax Act. I think that's a real big one that is hard to explain. It's hard for people to wrap their head around. I want to go into the U.S. exit tax, which I think a lot of people, I get inquiries on that all the time. We help a lot of people do exit tax planning. And I want to, talk about some basics for that. And then maybe if we have some time, we can get into some things that I think, Phil, you're doing now related to CFCs, controlled foreign corporations, and kind of what you're doing out there. But before we get started, just to get the audience a little background about who you are, Phil, can you tell them who you are briefly, your licenses, where you're located, all that good stuff, so they know what type of professional you are?
Hey, well, thanks for all of that, Mishkin. Phil Hodgen, Pasadena, California lawyer. So that's the one license, only license I have. And all I do is international tax. We have lawyers and accountants in the house. So it started that with the OVDP, where we just needed to, just in self-defense, to have accountants on the team. But that's all I do. And thanks for the kind words about the presentations. So I can tell you the dirty little secret. It's not going to be fun for you, but the answer is go take a course in symbolic logic in college. Go to your local community college. Learn how to break down sentences into basically word algebra. And that's the rock bottom simplicity. And from there you can build up.
Oh, wow. I did not know that that's what you did there. I see you do it all the time, though, and you use really good kind of symbols and graphs to kind of illustrate that out, too. So I did not know that's where you got it from.
Tax law is all definitions and if-then statements is really all it is. So you break it down to that, and you can start to understand it for yourself. Once you understand it for yourself, you can explain it to other people. And I will sit still to this day, been doing it a long time, sit through boot camp presentations, basics, because you just have to go back to those foundations again and again. Man, my brain just loses stuff about 14 minutes after I learn it. So you just have to. But yeah, that's what I do. I do a monthly webcast for CalCPA called the International Tax Lunch, and that is a lot of work, but it's a lot of fun too. So
And
we'll talk
CalCPA,
about that. I just finished a 6-episode series on FIRPTA, so we'll talk about that. Before that, I did an 11-hour episode on 5471s,
Yeah.
And starting in November, I'm starting a 4 episode series just on foreign trusts
Oh,
because,
yes, that's what you're doing. Okay, you're not doing
yeah,
two.
yeah. I
Wow.
mean, I have a friend, Kip Dillinger, who's here in LA, a CPA, and he does a lot of work with AI CPA. His practice is expert witness on the defense side for accountants in malpractice cases. And I was talking to him a couple of weeks ago, and he said, the number of malpractice cases in the international arena has gone down over the last few years. But the biggest thing that we're seeing right now, you know, out of all of the international malpractice cases is trusts, foreign trusts. And the problem is people not spotting them. So learning how to spot a trust, you see a piece of paper with a dollar amount on, or that there's an asset, or there's some income, and you look at it and say, what is this? And where do I put it on what piece of paper? That's the key thing. And so for those of us who are in the practice in international arena, people go overseas and they've got money parked in whatever it is. You got to understand, does this trigger Form 3520, 3520A? Because
Yeah.
that's at least that's the problem du jour. There will be another problem in a few years, but that's the one right now.
And it's funny. I think on Friday of last week. So we're talking about the 25th of October. When I say that, the Commissioner Danny Werfel announced that they were going to stop doing the automatic assessment of penalties on the 3520, 3520A, and
Aren't
that
they
they would,
wonderful?
yeah, and that they would look. Here's the funny thing is everyone's hailing that as some kind of victory, and that they would look at the reasonable cost statements. But in my head, I'm like, yeah, but they're going to look at the reasonable cost statements, and they're probably just going to still assess the penalty. So now you're fighting reason. What is reasonable cause, and you
Mhm.
maybe have to take that on appeal, and then to a court of law, and I'm not sure that that's going to be the silver bullet that everyone thinks it's going to be.
I totally agree, because if they say, "Oh, you've got reasonable cause," well, you and I know that what the government thinks reasonable cause looks like, and what you and I think reasonable cause looks like, and what somebody who has a foreign pension that happens to be classified as a foreign trust thinks reasonable cause looks like. Three wildly different things. And even if you say the government certainly doesn't have a unified view on what reasonable cause looks like, the person looking at your file who had a fight with his wife the night before and got yelled at by the boss in the morning may be a little bit grumpy when making a decision on whether you're going to pay a metric ton of money as a penalty or not. So I don't think reasonable cause is. I mean, here's an idea. Why not have something less than nuclear wasteland level penalties? Huh? There's an idea.
And when you say nuclear wasteland penalties, just to clarify for the audience, we're talking about $10,000, or in some cases, some of the trust penalties are 5% of what's in your trust or in your pension, or 35% of what you've contributed or what comes out
Yeah.
of it. Which I don't know about you, Phil, but I've seen some of these Australian superannuation fund or Australian trusts that come back with hundreds of thousands of dollars of 3520, 3528 penalties, and that I think is what you're referring to as nuclear wasteland. Is that correct?
Exactly. If you say the So if you don't play in foreign trust land, the penalties are 35% of whatever you put into this trust, 35% of whatever you take out of this trust, and if it's a foreign grantor trust, you know, in traditional tax rules, 5% a year of the asset value. Well, 35 and 35 is 70, and it doesn't take too long to get to 100%, does it? Right?
No.
And your point about seeing penalties in the hundreds of thousands. I run a little group for international tax pros, and there's a guy in there who says that he has been getting no penalty outcomes on 3520s, by sending in the reasonable cause letter along with. And so what that means to me is that the enforcement is way all over the map. And what why have a tax administration that's basically Russian roulette?
Yeah.
Really.
And why is that penalty so burdensome compared to, say, a foreign corp? Let's say you had a $12 million foreign corp. Max penalty there is 10,000. Well, I guess you could have a continuing penalty that maybe pushes you up higher, but the penalty there is just $10,000. There's no like 5% of your stock in a $12 million foreign corp, right? So it's
Exactly.
I think apples to apples when you're comparing your different, and I'm looking at a controlled foreign corporation versus a foreign trust versus a PFIC. The penalty levels are way out of whack in regards to the different structure that you happen to be in.
Yeah, it is. It is a crazy thing. I mean, similar penalty problem is gifts from foreign person to a U.S. person. Same, catastrophic penalty,
Right.
25%. Um, and I've seen those used as a cudgel to bludgeon the taxpayer into submission in an audit. I had one where the guy inherited a few $1 million of property from his mom in Taiwan. And the revenue agent was not shy about saying, if you don't agree to X, we're going to impose this penalty on you. And of
Ooh.
course, we agreed to X, right? Because why wouldn't you? So, um, yeah, it's a problem.
Yeah, there was a case that was settled, I believe, in 2022. They named it the Polish lottery winner case, or son of the Polish lottery winner case. It was the same kind of fact pattern where I believe there was a 3520 part four, and they were going to look at reasonable cause. I remember they stated there was reasonable cause. They were going to look at it. And then, as all good cases are, they settled it. So we never got to see what the court thought about the reasonable cause, which is
Hmm.
like, oh, we really wanted to see what you were going to say there. It never happened, but I think that goes back to the first topic that we talked about, which is okay, if they're reading the reasonable cause, like you said, what standards are they really applying? All we know about reasonable cause is what we've cobbled together from the Internal Revenue Manual and maybe some court cases and some articles published by tax practitioners that maybe deal with this on a regular basis. But there's nothing like definitive out there that helps guide someone through what that is. So I think that continues to be the $1 million mystery box, if you will, when it comes to these things. Do I do reasonable cause, or do I do streamline filing, or do I do OVDP, or nowadays it's the IRM OVDP, the different doors that you can walk through?
Yeah, and I have completely stopped doing anything controversy related just because, like everybody, we did a million voluntary disclosures back when the government was going after innocent Swiss bank accounts.
Right.
And I just, when you've had a couple of weeping school teachers out of the country looking at catastrophic bites out of their retirement or their kids' education account. Yeah, it just wasn't doing anything good for my soul. I mean, I wanted to
Yeah.
go build a little cabin in Montana and write manifestos, and that's not good. So, you have to back off and know. So I just send all of that stuff out. And so I know the reasonable cause stuff and the strategic choices from an academic point of view and historical, because I used to do a lot of it, but now I do none of it, and I just give it
Yeah.
somebody's who done 25 years of banging heads with the government, somebody who's come out of district counsel's office or the DOJ and has just litigated these things. How am I going to replicate that experience? I'm not.
Yeah, that's tough. I know of three or four good ones that what you're talking about, attorneys that do that kind of stuff. We've been doing the paperwork for that, though, the tax returns and the streamlined filings, and we even started with the OVDPs back in 2009. So I always tell people I've seen it for believe it or not, I've seen it for over a decade. It's still shocking to me that we have, when we talk about OVDP, I mean offshore voluntary disclosure, and then the subsequent programs that came out in 2014, streamlined filing. And it's shocking to me a decade later, we still have streamlined filing programs available to people to try to come into. But I believe the IRS likes it. I think it goes into that 5% penalty goes into a little black box, and who knows what they do with that money from there.
Mm-hmm.
There's no line item in the IRS budget for
Yeah,
the 5% Title 26 miscellaneous penalty funds that they get. So it's hard to follow where that cash goes to.
cigars for the commissioner.
There you go.
I don't know. No, I mean it is an interesting thing. I'm glad they have the window open because it's extremely valuable. I mean, if not to go religious or anything, but if you want to confess your sins and come to Jesus, make it easy, right? Make it
Yes,
easy.
I agree.
Uh, yeah. So, and that's not the case. But having watched it through the OVDP OVDP days that you and I went through, and the government had these amazing penalties. For instance, Indonesia went through a similar thing, and if I remember right, the penalties were like 1 or 2%
Hmm.
of undeclared assets, and the amount depended on whether you continued to leave the assets offshore or repatriated to Indonesia. From memory, Italy had a similar one around that time, and the percentage penalty was very, very low compared to what we're paying. So I don't get, I mean, maybe it's our Puritan forefathers, right? Yeah, yeah, punish the sinner. I don't know, but it's dumb.
Yeah, yeah. And I think what you're referring to, Phil, is the 27 and a half. And then in some cases, if your name was on a blacklist or your bank was on a blacklist, then you got a 50% penalty. I mean,
Hmm. Right.
I mean, some of these things were extraordinary, and it's led. We're still seeing now to this day. I'm still reading cases about OVDP opt-outs and people getting prosecuted under that. So it seems to be the never-ending saga there. I want to switch gears though here because we're going to run out of time, and I want to make sure we get to what I said we were going to talk about here. Um, I want to talk to you about FIRPTA. Tell me about FIRPTA. Tell me about your series on FIRPTA. Let's tell the audience first. What is FIRPTA? What do I mean when I say FIRPTA? Who does it apply to? Tell me about. Give us some quick background on FIRPTA, and tell us about your series on FIRPTA and why you did it, and maybe some good juicy tidbits or nuggets for our audience so that they can kind of walk away with something here.
Okay, let's do it. Okay, FIRPTA is an acronym, so it's insider jargon. So if anybody ever uses insider jargon in front of you, if
That's
you're a
me.
normal person, go slap, 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 slap. Speak to
Yeah.
me in English. So FIRPTA means Foreign Investment in Real Property Tax Act. It was enacted in 1980. I graduated from law school 82, so it was right before my time, but I still inherited enough of the way it was in the old days to understand the idea. So why they put this in place was a non-resident would buy a piece of real estate and put it in a domestic corporation, typically owned by a foreign corporation, and then the investor would own the foreign corporation. We use these to this day, but
Mhm.
the cool thing before the Foreign Investment in Real Property Tax Act before 1980 was when they wanted eventually the time comes to sell the property. Well, a buyer doesn't want to buy stock in a domestic C corporation. Buyer wants the asset, the
Right.
real estate, to buy out of the C corporation. So what would happen would be the domestic subsidiary would sell the real estate to the normal buyer for cash and have cash in it. Okay. What would you do with that cash? Well, you would pay the tax, but then the you know you would have a problem like this. Okay, you're going to have an income tax on the seller side, and everything's good on the buyer side. Okay, foreign investor doesn't want to pay income tax, so what do? They would sell the shares of the stock to the buyer. The buyer doesn't like this because the asset basis inside the corporation, it does not get stepped up to the purchase price.
Right.
But there was this thing at the time called the general utilities doctrine, where the buyer could make an election to step up the basis of corporate assets, and to
Oh,
the purchase price of the stock.
like a
And so,
733B election for partnerships, something like that.
yeah,
Okay.
this went away in the 1986 Tax Act, so it disappeared. So the idea was, uh, this is what I'm going to do. The foreign corporation sells its domestic subsidiary shares. That's a non-taxable event for a foreign person because it's not fixed, determinable, annual, or periodic, and
Okay.
it's not effectively connected income. Boom, tax-free
Yes.
liquidation.
Love
Okay?
it.
So that's why it was put in. They wanted to stop that specific thing, and that's why you see the definition of U.S. real property holding company and U.S. real property interest and all that fiddly-do stuff in Section 897. So
Yeah.
that's the sin that was being prevented. So don't let people do that. And
Uh,
between Section 897 and repeal of the general utilities doctrine, they solved that problem. Now a foreign investor and a U.S. investor are going to pay capital gain tax no matter what, roughly equivalent. There's a little bit of difference in that if you and I, one of us is non-resident, the other one is resident. We sell, we have personal long-term capital gain. I, as the resident, will pay the 3.8% net investment income tax. You,
Yeah.
as the foreigner, will not. So
Right.
the tax system still slightly skews in favor of foreign investors, but yeah.
Okay.
Okay, so that's why it exists. What does it do? Basically, if you boil it all out, it makes everybody pay capital gain tax on investments in real estate without regard to clever lawyer tricks and holding structures. It's going to happen. I mean,
Yeah.
there's some exceptions for REITs and stuff like that, but that's, you know, we don't live in that world, you and I. So,
No.
right. so, um, so, so that's what it is. And the the thing that everybody in the real world sees about the Foreign Investment Real Property Tax Act, FIRPTA, is the withholding tax at the time of sale, which is 15%, 1/5 of the sale price.
Right.
And typically the withholding is far, far in excess of the actual capital gain tax that's liable. And so what you have is somebody who is a non-resident sells property, has this 15% withholding, and now they've got to file a tax return, and then they got to wait for donkey's years for the refund check to come back. And checks get paper checks get mailed overseas to the seller. So I had an exciting experience where 3 checks in succession got mailed to Mexico and disappeared. What
Of
a,
course.
yeah. Oh dear. So, they never got cashed, but they never got there,
You
right?
never
So,
got there. Yeah.
yeah. So the problem is, you just, on the income tax side, you just say, yeah, I'm going to pay income tax on this, the capital gain tax, just like a resident taxpayer, more or less. But this withholding tax is bad. And think about, like, when there were a market downturn and you're just trying to cash out and you've barely got any equity, or maybe, after you pay the broker and everything, you've got to dump a little bit of cash in to close the deal. Well, where's the 15% going to come from to give to the IRS?
Right.
So it's a problem either because the foreign investor doesn't trust the government will send the money. My experience is that they always send the money, even when it's a big refund. So, but in other countries, people are not so sure that money will come back from the government once it goes in. So there's this lack of trust, but it'll come back. But it's a time thing. And back in the bad old days when interest rates were nothing, that didn't matter. But now you've got T-bill rates at 4 and 5%, and it matters,
Makes a big
right? So,
difference. Yeah.
yeah. So one of the things that the government did said, well, okay, if you write to us and you fill in this form, 8288B, which is one of those iceberg forms, which is just one page of stuff you fill in, and then about 14 pounds of paper behind it as supporting documents. But you prove that you have capital gain tax liability for reals of 0, then we'll send you a letter saying the withholding tax is waived. Great. And in the regs, it says, and we'll do this within 90 days. Well, this is kind of a problem if you have a 30-day closing, but you can have the title company or the escrow company hold the money for you for a little bit until you get the letter back from the IRS, and then they'll burp out that 15% to you. Okay. Except I've had 2 recent ones where the government took 15 and 17 months to process this and give the waiver. And one of them was a $35 million sale. So you can
Oh,
imagine what 15% looks like that. Another one was
ouch.
an $8 million sale. So again, big numbers. And if you look at the opportunity cost, I could have this money in T-bills right now, or it could just be sitting there earning bupkis. The escrow companies, I think, paid us 0.5% or something like that,
Oof.
you know,
Yeah.
on millions of dollars, right? And, one,
And they don't want to hold that for 15 months, right? They're going to
they
argue with the,
really don't. No.
but they're required by law to hold it until they get the letter, right? They can't just
Right,
send the
right.
money
Because
in.
otherwise they are personally on the hook and personally liable
Right.
for, they're the withholding agent,
Yeah, the
well,
withholding agent. Yeah.
agent of the withholding agent,
Yeah, yeah,
and
yeah. That's right, because the buyer's
right,
withholding agent.
yeah.
Yeah. Yeah.
So that's the whole problem with FIRPTA. FIRPTA is an income tax problem.
Right.
Oh. Um, but when you think more generally about non-residents buying U.S. real estate, especially if they're humans, the real problem is the estate tax. Because if in a moment of poor judgment you fall over dead and you've got a U.S. asset and you live abroad, so what? Your heirs are going to pay the U.S. estate tax, and it can ramp up to 40% with current tax rate fairly quickly. And the dirty little secret here is that for US citizens and residents who fall over dead, there's this unified credit that covers what, round number 13 million right now. For non-residents, there is no thing. The first 60 grand is exempt from US estate tax, but otherwise, boom, off it goes. And you're going to hit the 40% maximum tax rate at a little over $1 million of assets. So when you're talking about FIRPTA, we're talking about how do you manage the income tax thing, but really the income tax thing is just to get you to stability so you're taxed the same as a US resident on rental income, on the capital gain on sale and stuff like that. The real problem is on the estate tax side, that you don't want to have estate tax because it's a, low probability. But do you feel lucky?
Right.
And
Right.
sometimes, most of the
And,
time, people are right. They don't die.
and do you also see that being an issue with some states that have state estate tax? Would that also drag it in? So I think, for example, Maryland and DC have a state estate tax on top of the federal estate tax. Now you're potentially dealing with two different jurisdictions that impose an estate tax. You ever see that occur?
You know what? I've never had that experience, but
Okay.
my personal belief is you vote with your feet and punish governments that do dumb shit like that. Oops,
Yes,
sorry. Sorry.
that's all right. That's all right.
Sorry.
Um,
Yeah.
what I tell a lot of people is to be careful with that state estate tax. So, for example, a lot of my clients are in the Virginia, Maryland, DC area, and Maryland and DC have that state estate tax, and I think DC's threshold is quite low. But Virginia, strangely enough, has no state estate tax. So I always tell people, like, if you're going to own that big, massive, nice house in the Maryland, Virginia, DC area, do it in Virginia, so that at least that potentially do it in Virginia, because that's one thing that you can avoid there.
Mhm.
And then I just wanted to add a comment on the processing of the 8288B. We actually talked to, believe it or not, we somehow got through to one of the IRS folks that does that review. And they told us that they're a subset of the IRS corporate. One of the, I guess that would be, used to be LMSB when I was there, but it's LB&I now. And that they only check those applications like twice a week or once a week. And so imagine all the 8288Bs get dropped onto a desk. This is what I'm thinking in my head. And then you have some IRS person that says, okay, this is my once daily FIRPTA check-in. And they look at the stack and they're like, okay, I'm just going to grab these 4 applications. I'm going to look at them today. Next week, I'm going to grab the next 4. But you think about how many probably flow through that office. The
Mhm.
reason why it takes so long is because if you have a limited staff and a whole bunch of submissions, it's going to take forever for them to get through that. And to me, that's, like you said, the regs say 90 days. That's a complete inaccuracy from the regs to what was going on there. So I think that's the insight that we got, and we really tell people not to do. I try to urge them. I'm like, look, 8288B, that's going to take you, like you said, 15 months. We've seen it take 2 years. No one is happy with that result. The escrow company that holds the funds, they're not happy. You're not happy. The buyer maybe gets a penalty. They're not going to be happy if something goes south. You know, um, we tell them, sell the property towards the end of the calendar year if you can. I know you can't control when properties sell. you know, file as quickly as you can within the next calendar year. Make sure you get that 8288A, which it's your golden ticket. I call it Willy Wonka's golden ticket. You got to have that with the crazy red stamp. If you don't have that, you're not going to get your money back. I think
Mhm.
temporarily they said you could send a copy of the canceled check and some other things from the escrow company, and they had maybe used that to try to find it. Do you have anything outside of that advice that you've heard about or that you guys do to try to get the FERPTA funds back faster?
No, if the government has the money, you just file your tax return and
Try to
wait.
get it in there.
Yeah,
Find funds
but
for,
I will tell you a strategy that we've used many, 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 many times.
okay.
So imagine a non-resident owns a piece of real estate just in his or her own name. Okay, coming up to sale time and saying, this FERPTA withholding stuff is garbage. I don't want to deal with that. All right, step one. spin up a little C corporation in that state. Step 2, contribute the U.S. real property into that little C corporation. That will make it a U.S. real property holding company as defined in Section 897. That's a tax-free event as long as you send the IRS the correct notices at the correct times,
For the
and that's in the
paperwork.
regs.
Yeah.
Okay, now you have real estate in a domestic corporation. It has carryover basis, so the same basis as in the hands of the individual now shareholder. Step 3, the corporation lists the property for sale and sells it, gets cash. Okay. Step 4, now what? Well, corporation pays federal corporate income tax, 21%, not too different from 20% long-term capital gain, is it? um, Pays the state tax. In California, for any significant size of property, you're talking about 12% marginal rate. Corporate tax rate is 8.84%. So that's
Okay.
better.
That's better.
Okay.
Yeah.
Now, so you pay the tax, and what we do is we then, you know, decide, oh, we're going to liquidate. We do a liquidating distribution, you know, and then the liquidating distribution comes out tax free to the shareholder, because a liquidating distribution is treated the same as the sale of C corp stock.
Okay.
So now, corporate stock sale by a foreigner, not taxable. So it's not a dividend with 30% withholding. Cash just goes upstream. Now, there's some paperwork that you have to do to tell the IRS what's going on. Again, notice, all that stuff. So now at the end of it, what you've done is, for approximately the same tax cost on the capital gain inside the corporation, you've got a domestic seller, no withholding, and off you go.
So that's your end around for the FIRPTA withholding, and then the upside is that the cash goes quicker. You pay, but the downside is you may pay a little more federal tax, and there's some paperwork that you have to file. So you probably need to get an accounting firm to do that for you. Make sure you do all your compliance,
Mm-hmm.
1120, 5472, FinCEN, BOI, open and close in the same year, et cetera, et cetera.
Correct. Yeah. What you're doing, you're buying a benefit, bypassing the FERPTA withholding.
Right.
What you're paying for it is a lot of money to people like Mishkin and me, and you're filing a bunch of paper, and it's ridiculous, but you just do it because it's cheaper than waiting for a year for your
Time
refund.
value of money. Yeah. Well, can
Yeah.
we can your return pay for my fees? That's the way you got to look
Uh-huh.
at
Yeah,
it.
exactly. And so above a certain deal size, it's totally worth it. Below a certain deal size, it's totally not worth it. And you just sort of price it out and you say, what do I want to do?
Okay, great. Let's move on to the exit tax because I really want to talk about this. I talk to people about this all the time. So the current version of the exit tax, what is that? That came out in what, 2008, and I think
Mm-hmm.
the only real guidance we got on that was Notice 2009-85. And in that, they said they're going to put out regs and they're going to put out this magic form called the 708 for 2801, which still does not exist to this day. I chuckle about that. I've actually had people have 2801 liability and that have asked us to create Form 708 to calculate and pay the tax. And it's like, I'm not sure I can do that.
Uh-huh.
Uh, so walk me through your thoughts on the U.S. exit tax, because I know a lot of people, they are flabbergasted that the net worth test is still $2 million, which comes from, I think that's even prior to 2008, right? That number was in there in the 2004 rules, maybe. But
I don't remember what the old number was, but yeah,
yeah,
why was this not indexed for inflation the way everything else was? I don't know.
yeah.
Um,
Give me give
yeah.
me give me 2 cents on the exit tax. Let me hear what you
Okay.
got.
Um, so the predecessor exit tax was, you know, if if we think you're doing this for tax purposes, we're going to tax you. So it was a totally subjective test, and you have to get a letter ruling from the government or play the "Do you feel lucky" punt game. So that was Section 877. That was superseded in June of 2008 with the current rule that says we don't care what your motivations are. You're going to go back to the family in the home country, or you're doing it for tax purposes. We will tag you as you go out and make you pay your fair share because you got rich living in the United States and holding the magic blue password. passport. So 2008, imagine it in simple terms. It's a giant mark-to-market event across all of your assets, and you pay any capital gain tax that you owe, and you're out and you're free, and you exit the U.S. system permanently. I think I must have done one of the first ones because I had a woman in Switzerland who went into the embassy in Bern 3 weeks or 2.5 weeks after the new law was in effect, and they wouldn't let me in the room because they thought I was going to impose on her and duress. We can't let you in. You might influence her. Oh, shut up. So I sat outside. Um, so that's what it does. And I don't know what the stats are now. 5 or 6, 7,000 a year people do it. I think there are many more that can and should, particularly in the green card category. Um, at any given point, we'll have about 5 or 6 of these files going.
Yeah,
We do a
yeah.
lot of them.
We have more. Yeah,
Um,
we have a lot more than that. But yes,
yeah,
there's a lot of people that inquire about it.
yeah, yeah. And there's a lot of people that inquire about it and never pull the trigger. Um,
Yep.
here we are shortly before an election. I remember in the Obama years, you get a bunch of grumpy people calling, the country's going to go to hell. I'm getting out of here. And then
Right.
Trump got elected. The country's going to go to hell. I'm going to get out of here.
Yeah.
You know, you know. So frankly, in my opinion, and apologies to anybody where this hits close to home, if you're motivated by politics like that, you're probably not going to do anything. Just relax and have a cocktail. So,
Right.
you know, um, so that's what it does. And so the idea is you're either going to get out of the U.S. system by giving up your passport. And the way you do that is you go into a consulate or embassy abroad and you go through and you say the magic words and you raise your right hand and you look at the flag while you're doing it, blah, blah, paperwork, and you're done. Um, so when you go through that process for tax purposes, you either just have a paperwork problem or you have a paperwork plus a tax problem. So if you and the threshold is you're either a covered expatriate, defined term, insider jargon, or you're not. And a covered expatriate, I break it down into two categories. You're either a bad person in Uncle Sam's eyes, or you're rich enough that they want to turn you upside down and shake you and get the loose change out of your pockets as you're leaving.
Right.
A bad person it's called the certification test, which means the 5 prior years of tax obligations under Title 26 of federal tax law are out of whack. So if you have any problems there, you can't check the box and say yes, I'm clean for the prior 5 years. You're a covered expatriate, and you're going to have a tax problem. Then the rich category is your net worth is either 2 million and above, or it your and which is not indexed for inflation, or your average income tax liability, federal income tax liability for the last 5 years is, for 2004, I think is 201,000. It's indexed for inflation. I think it goes to up to 206,000 next year.
And
But
that's not to be confused with your adjusted gross income, because people always say,
right,
"Well, my adjusted gross income is 200." I'm like, "No, it's your
yeah,
tax liability. You got to make a lot of money to average
yeah.
201,000 or whatever it is."
Yeah, and the other thing is, especially for Americans living abroad, you reduce your federal tax liability, which is basically just regular income tax and
Mhm.
AMT, and there's some adjustments, and it's usually you don't have to go into the adjustments because it doesn't make a difference.
Right.
Um, but you subtract foreign tax credit from that. So someone living abroad and making a metric ton of money and having a metric ton of tax liability, but fully offsetting it by foreign tax credit, the actual tax liability in US, according to that calculation, is very low. So, somebody living in a high tax country in Europe, Australia, places like that, no problem. So anyway, so you're good or you're bad, you're rich or you're poor. Um, if you're poor, you just have some paperwork. It's Form 8854. You fill it in. Yeah, it's a bit of a pain in the neck, but you do it anyway. The biggest pain in the neck is a balance sheet to prove that indeed your net worth is below the magic number of whatever year you expatriate. If you're above, then we have a tax problem. So let's start from the easy ones. First, all of your IRAs, it's like you had an immediate dump. You recognize the income at the moment that you expatriate. So you got 200,000 in an IRA, boom, you got 200,000 on that exit year tax return.
Ordinary income.
Ordinary income. The
Okay.
nice thing is they waive the early prepayment, early
Oh,
distribution
how nice
penalty.
of them.
Yeah. so then we come down to deferred comp of all flavors. And there's either eligible deferred comp or ineligible deferred comp.
Okay.
The eligible deferred comp basically means there's a pension administrator in the United States that's responsible for withholding, and if that pension administrator screws up, the pension administrator is fully on the hook for the tax withholding. So the
Oh,
government knows they're going to get their money one way or the other,
right.
either from the taxpayer who's getting a pension distribution, for instance, or the administrator if they screwed up. Side note on FIRPTA, I've talked to title companies that have screwed up on the withholding, and the government's come knocking and indeed forced them to make the payment for withholding they should have done, but they didn't because
They
they
didn't
screwed
do.
up the
Yeah, I've
paperwork.
heard that too.
So it's a serious thing. If you wear the magic hat that's called withholding agent in the IRS's eyes, you're on the hook. So that's the pension, and the ineligible pensions are everything else. Like you work for a company abroad, and there's a pension plan there. Well, there's no pension administrator in the U.S. to make sure that with taxes withheld as distributions are made to you. And for the eligible, it's a pay as you go. There's a withholding tax imposed, and off you go. 30% of the distribution, and and if you don't know that much, and I've seen this a lot, every year 30% is withheld. You file a U.S. tax return. You took too much money, and you get a refund, and there's no way out of that loop.
Right.
For ineligible,
You're locked out of the treaty for what, 10 years, right? Or even if you can get the treaty after 10 years, are you still locked out?
you're locked out. Period. The
No
end.
matter what. Okay.
No
But
matter what.
generally speaking, once you're a covered expatriate, you're locked out of all U.S. treaties for, they have that in
For
the savings clause right above it. They kind
yeah,
of
yeah.
lock you out for 10 years.
Yeah. So then the fun one is the ineligible one. So you're an American abroad who worked in the UK for 25 years and retired with a pension. It's an ineligible deferred compensation plan for exit tax purposes. Your tax as you leave the US tax system is the lump sum present value of all of your vested pension. Okay? So you pay the government of the United States this giant exit tax, but as far as the UK tax system is concerned, nothing happened. Now you retire and you start taking distributions, and the UK system starts saying, "Oh, we want tax," because you're starting to get distributions. So you get double taxed on that thing, which is not fun. So,
The only country that I think actually has that, I've only seen this in New Zealand. If you look at the New Zealand tax treaty, they'll actually give you a credit for your exit tax paid. It's a really weird provision that only occurs in that one treaty.
hmm.
Um,
I don't know if I didn't know about the New Zealand one. I don't, but the one that I am familiar with is the Canadian treaty, where they have synchronized the
is it for their
U.S. exit tax and our equivalent and their
right?
equivalent.
Yeah, yeah, yeah. Okay,
Yeah,
yes, I know that's
yeah.
in there too. Yeah.
So, so yeah. So, anyways, that's the deferred comp, and there's some other stuff that goes on, but that's the idea. And then everything else that's not an IRA, like the Beastie or a deferred comp plan, mark to market tax, and it's the first band of the mark to market capital gain that's tax free, and everything above it is just taxed like normal capital gain. So you get grumpy when people look at this number and you say, I got to pay that much just to give up my passport. And if they're going to a tax-free place, I learned this from doing this with a few hedge fund guys, because they would look at that number and they'd run the math in their head really quick, and they said, I can make that back in 37 months, right? Because they're living tax-free. So I went, oh, okay, the
Okay,
power of tax-free compounding. So,
yeah, that's
so
fantastic.
yeah. So
Do you feel like there could be an update to the exit tax? Do you feel like we might get a new one, or they may adjust for inflation? The foreign trust regs that came out in May, the proposed ones talked about doing some updated regs for 2801, kind of yeah, I think that goes back to the arrestee case where the court basically said no notice in the hearing for the exit tax. It doesn't apply to that particular taxpayer, not an issue they're going to talk about. Do you feel like the IRS knows there's a little bit of an issue with what they have there right now, and perhaps Congress might do something about it, or IRS might do something about it?
I think they know they have an issue. I don't think anybody will do anything.
Yeah, I think it'll
And
just be
I,
exit.
I refer back to history on this. So
Okay.
you think about Canadian Registered Retirement Savings Plans, RRSPs.
Yep.
So
Yep.
their equivalent of our IRAs.
Yep.
It took the government about close to 2 decades from the time that they first woke up and said, oh, these things look like foreign trusts. Where's your 3520, 3520A? Then received a giant shitstorm from Canadian banks and Americans in Canada and everything else about that, and slowly backed away. And eventually they published a single form saying, you don't have to do the 3520,
Yeah, I
3520, but
hated
do
that.
this form. And then eventually they said, never mind.
We're not going
Finally realizing this is a government mandated, government operated thing. Nobody's using it for tax evasion.
to. Right.
Shut up. So if okay, so it took him close to 20 years to do that. And I remember during these days, I talked to one of the people in chief counsel who was, responsible for all this stuff and was trying to push it forward to some sort of sanity. And he wanted some sort of sanity, like, how about no paperwork? Way back in the beginning. And he recounted sitting in one of these meetings where they were talking about what to do. And he said, well, we'll have this form, 8891 or whatever it was.
Yep. Hmm.
And he said, and then I said, who's going to process those forms? We're going to get about 350,000 a year. Who's going to process them? And I went, we want that farm, right? So, I mean, that's what's happening.
Yeah, it's always funny to me when the IRS puts out like comments on some of these forms, and they're like, these are the expected number of respondents, and you're like, I think it was like the 3520 or 3528. They said like 1,700 people filed those forms, and I'm like, that's impossible. That's
Yeah.
literally nowhere near the truth of who files that form. It's got to be at least 50, 100,000 people file those on an annual basis, and to put out.
It must be. Yeah. I agree. Those estimates are wildly wrong,
Yeah,
as are the estimates of the time needed to prepare the farm,
yeah.
frankly. So,
Okay, well, let's close out here. If you could just in the last couple of minutes here, tell us about what you got coming up. Tell us a little bit about what you're doing with CalCPA, and tell our folks if they wanted to reach out to you, how they can get in touch with you, and generally how you work and what you're kind of offering these days.
okay, so what am I doing with CalCPA? Have an ongoing monthly live webcast, the International Tax Lunch, which last Friday of the month, noon Pacific time. Been doing that with CalCPA for long, and I will do it for as long as they want me to do
I'm
it.
sure we'll let you do it for.
Um, yeah, and it's fun. I love doing it.
Yeah, they're fantastic.
I'm also on the organizing committee for the International Tax Conference that CalCPA does. So we're
Oh,
having it. It's back to live again finally
oh,
after
congratulations.
all that fun stuff. So that'll be at the end of January of this year, the 29th.
Very cool.
And I will not be speaking because I chose not to, because I have a speaking gig at the New York Society of CPAs International Tax
Oh,
Conference
great
on the
place. Yeah.
23rd. So I'll be talking about filing categories for Form 5471, trying to
Lovely.
get some, what box do I check? Um,
That's actually a good one
and,
though. A lot of my staff probably need to attend that one, but keep going. Sorry to interrupt.
you can't get back to the basics enough. And that's one of the basics. And, like even before that, do I even have a corporation? Sometimes that's puzzling, right?
Yeah.
I mean, having had recent experiences with Indian LLPs, and we look at these and say, "Oh, it says partnership in the label, right? It must be a partnership." Uh-uh.
It's liability. It's a corp.
Yeah. So I do that. Let's see. November 12th, I'm doing a online thing for the American Law Institute CLE on expatriation. It's a
Great.
2-hour thing. I'm the first hour talking about exit tax. The second hour is someone from Henley talking about
Oh, a lot
second
of
passports and where you do that.
that thing's
Um, what else am I doing? I have this newly spun up little mini group for international tax pros. So go look at internationaltaxlaw.com. Um, that's a lot of fun because a lot of us, you're in a larger group, so you have people to brainstorm with. A lot of us are little solos or small firms, or it could be in a big firm, but you're the only one that does international tax. You get lonely. You need to brainstorm. And that's the whole point of what we're doing there. And also, having been in practice and run my own shop for a long time, to the extent I can help people say, don't make this mistake. I made it for you. And it was expensive, so don't do it.
Learn from my failures. Yeah, of course.
Yeah, exactly. So that's what I do. I mean, if you need to find me, Hodgen.com, my last name, HODGEN.com, or, internationaltaxlaw.com. I'm there too. And Phil in both cases.
Perfect. Well, Phil, it's been such a pleasure. I'm so glad you were able to come on the podcast. I know you're super busy. You got tons of stuff going on. I would tell anyone listening to the podcast today, if you have the opportunity to catch Phil either in person at one of his presentations or at his Friday luncheons, or any of the stuff that he does, it's well worth your time and energy. And I do think in some cases, Phil, you do some of those events offer CPE and CLE. So if you're an accountant or a lawyer, I think you can get some educational credits to go along with
Correct. Yeah. CalCPA hands out those cookies. The basic deal is if you want to watch for free, you can. If you want an hour of credit, you pay CalCPA some amount of money and they give it to you.
Pay your toll for your CPA. There you go.
Yeah, exactly.
Awesome. Well, thank you, Phil. Thanks for being on today. Very awesome show. And we will see you next time.
Great. Thanks, Mishkin.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.